Goodness gracious me. Is the recession coming? Let's find out. Today we're going to be talking about everyone's favorite topic when we're looking at the market, and that's recessions. We all love recessions. We all love losing money. I mean, I know I do. That's for sure. So we're going to take a look at some of these factors here. I got a couple different articles to show you. A couple different data points. Obviously, a lot of people, you hear the noise a lot right now. People are predicting recession in 2020. It's happening, right? I'm still on the fence. We're going to go into a couple factors, which is leading people to believe that. I'm going to give my opinion straight off. At least from my understanding, I mean, obviously you cannot predict a recession. There's no chance to. I mean, people are always wrong when they try to. That's why economists and weathermen are the two jobs where you get paid plenty of money and you can be wrong all you want. That's exactly the same job pretty much. They're always wrong, but get paid plenty of money to do it. So, and people still listen. So, another reason, obviously, historically, we get a recession every 8 to 10 years. Last recession starting in 2009, late 2008 maybe. Which, if that's the case, we're due, right? You'd think so. 10 years later, 2019 here. You think we're due. But I don't necessarily think that a trend is always accurate. I mean, there's a good important saying for you math nerds out there. That's me. Correlation does not equal causation. I don't know. I think it's relatively important to say that. So we're gonna get right into this. This is crazy. So we're gonna get right into this. A couple factors right here listed. Obviously, the yield curve has inverted, which is obviously a major sign of recession, usually following a few quarters or a year after the inversion. You tend to see a recession, and that's just historically pretty accurate. And we can see by this chart here, and that'll be the 10-year Treasury notes compared to the 3-month ones. So, if we're looking at this chart here, obviously the green representing a 3-month to 10-year Treasury spread difference in them, and these gray areas are marked as recessions. So the only major exception you can actually see that wasn't leading to a recession would be back here in like 1963 maybe. Obviously we had one that hit in 70, but that was 2 years later, 2 to 3 years later, so not necessarily awful here, but you can see we have gone negative every time before a recession. So clearly there can be people can try to make conclusions here because it's pretty accurate. This does seem to be a little bit conclusive because every time it's happened, there's been a recession following, and we just this year dipped into an inversion on the yield curve. So, it's something to look at. Next, we have unemployment. Obviously, what is that? Oh, okay. Those are leaves. I was scared. I didn't know what that was. So here we go. Unemployment rate. Obviously, historical lows right now. And we see here marked recession since 1990. And from what you can see here, over the past 2 recessions at least, unemployment got to historical lows, and then obviously after that, shot up. Obviously nothing's nearly as bad as the Great Recession in 2008. That was clearly just awful, and as you can tell by unemployment right here. Obviously We don't want to see unemployment near 10% ever. And right now we're under 4%, which is, it's historical levels right now. So, and there's a lot of people that don't believe that it's something that can keep up. It all depends on economic growth. Obviously, we're still in a growing economy. It's slowing down slightly, but if the economy keeps growing, we create more jobs. Unemployment rate will continue at least to stay stagnant. As long as it doesn't go up, we're looking good. If it goes up, there's a chance for recession. Not necessarily a guarantee, but obviously we want a low unemployment rate, and hopefully we can stay to it for at least a couple more years before we hit another recession. So obviously now GDP here, the output gap. So as you see, obviously the GDP gap is positive right now, which will indicate, obviously it's a good sign, but obviously not a good sign in terms of recessions. But you can see every time we have a positive spike here, besides obviously back in 82, every time we've had a positive spike here, it looks as if we head towards a recession following that. But if you want to take an actual look at it, you can see we have plenty of room to go up before we hit recession talks. So again, that could buy us another year maybe. But who knows? At the end of the day, no one knows. Here we got consumer confidence. Consumer confidence obviously near all-time highs. And we can see again, we have the past two recessions listed here. Consumer confidence went to a high point, and then obviously dipped down as we started the recession and got very low, obviously, here in 2009, when obviously people didn't have jobs, so they definitely were not confident in their purchases. But now, growing economy, growing wages, consumer confidence is at a very high point. Now, I just find that as good. Everyone wants to be pessimistic about everything, but I like to just think of things as good. We're going to look at the markets next. So this will be the S&P 500 here. Obviously, we see a rise, and obviously, probably the dumbest chart I've seen in my life. Why does it got to be S&P has fallen during recessions? Well, that's not a shocker. Of course they fell during recessions because people sold their stock to afford normal life purchases. So that'd be why the S&P 500 fell. But right now, obviously, we're at a huge bull run right now. So that leads people to believe, well, it's got to end at some point. I hope it doesn't. I'll keep taking these gains while I can get them. But I can't see necessarily a major indicator right now. I don't buy it. Boom bust barometer. Obviously, I don't know much about the boom bust barometer, but it takes into account, I think, precious metals on there. Obviously, it looks like we're at all-time highs. And obviously, you hit highs before you get smacked down, but we're not getting smacked down. Housing market, we're nowhere near any major levels in the housing market just because of how much we got absolutely shellacked back in the Great Recession, 2009. Housing prices got devastated, and whoo-wee, if I was old enough back then and I had enough money to buy property, it would have been a fantastic time. Let me just tell you that. That's one reason why, hey, I might be looking forward to a recession. If I can get cheaper house prices, hey, I'll do it. That's a good investment. Real estate investing, you need a lot of money to get it unless we have a good recession. I shouldn't say good recession. I hate recessions. But so obviously nothing significant here as far as the housing market started. But we're pretty flat right now. Obviously, nice rise, then flat. Look at manufacturing. Pretty consistent here. Nothing major to look at. Obviously, manufacturing dips during recessions. What a shocker. Nothing significant there. Corporate earnings. Obviously, earnings fall during a recession and prior to. I could see it. Earnings, I believe, I could see a concern here. just due to the fact that over the past couple of years, company earnings have been elevated just a little bit. A lot of that's due to share buyback programs. Obviously, the less shares out there, the higher the earnings per share, because there's less shares flowing out there. And a lot of companies, due to the tax bill in 2017 lowering corporate tax, a lot of companies had a lot more money, and they spent that on corporate company buybacks on their shares, and that has inflated their EPS. And we're seeing a lot of companies kind of missing their goals lately, and that's pretty much due to the fact that they're going off these inflated numbers due to buybacks. And once those buyback programs run out, or they finally get through with all of them, we're probably going to see more negative earnings. So that's something to consider. But overall, companies are still making a lot of money here in the U.S., so thank goodness. Junk bonds we'll get into. Obviously, people flock to bonds once recessions hit. I don't know why people like to think recessions are a permanent thing, but people flock to bonds because they're a surefire thing, whereas the market in a recession typically is always going down. So, freight shipments, well, obviously I don't care much about these freight shipments. We're going to skip that. Misery index, here with a little bit of an ad. I don't want to think about that story, but that's all I got here for you. Next, I would like to go on to skip that. We don't like that. We're going to go to the price of gold and silver. These precious metals are things people tend to go to when we hit recessions as well. As themselves, really the value only comes in people purchasing it. I am certainly not a gold and silver guy myself. I mean, the only thing that to me it's kind of I don't know. I just don't like gold and silver. People are always trying to sell gold and silver. It doesn't really increase in value. You don't get anything off of it. Obviously, it's something that you can just have to say you have it. But I don't personally like gold and silver. I would not suggest investing in gold and silver or any precious metals for that matter. So here's just showing a lot of people flock to gold. Starting 2010, obviously recovering from recession where stocks weren't looking great, so people flocked to gold, increased the price, and people tend to be flocking to gold right now, actually, too. So it's a factor to look at. Over the past couple months, people have been buying a lot more gold and silver, and we're going to go look at silver as well. We see just a tiny, tiny spike in silver, but back in, again, 2011, that period, people were obviously scared after the Great Recession, just coming out of it. People tend to buy a lot more of this silver, but as you see, it loses value pretty fast. Just saying. So once people felt confident again, they started selling the silver off that they don't need. People weren't buying it. It wasn't hot of a market. And right now we're pretty flat, so nothing significant here that would indicate anything bad. People might be selling their stock, buying some gold and silver. I think those people are not smart for doing that, but you know. And finally, obviously, we have people flocking to bonds because they think it's guaranteed money, and it is guaranteed money. You just put money in, and you get paid a flat percentage. It does not increase or decrease from the time you buy it. The value doesn't increase or decrease. It's pretty much just investing in a flat company that's going to get you a dividend. It's just investing in something that pays you a steady dividend. Normally, you can get a bond anywhere from the 2 to 3% range. So you get a 2 to 3% annualized return, whereas the stock market, you get around a 7% annualized return usually on average. So people think short term a lot usually when they buy these bonds, so they aren't thinking about market recovery. And if you purchase during a recession, you can definitely get some good deals out there for the future, not just necessarily 1 year beyond, but 10 years down the road. You'll be happy you did. So here we see fund managers at Bank of America Merrill Lynch are most bullish on bonds since, guess what? Since the Great Recession. What a shocker. They say trade is overcrowded. and they're a fixed income source, which they are. You get paid regularly, some pay monthly, bonds, but I don't usually mess with bonds. And I finally want to leave you out here with Trump says the Dow would be 10,000 points higher without the trade war. That's what he says. He acted because China was out of control, and that's fine if they don't want to make a deal. So, here we go. One of the main factors, this is why people are scared of the market right now, is this trade war. So I think I'll make a separate video regarding what to do as far as investing during a trade war or recession is concerned. I'll get into that later, but obviously this trade war could have a significant impact on the economy in the short term, but overall, I think it's something that should be seen as positive. It might hurt investors at the moment, it might hurt us at the moment, but overall, I think a lot of people are actually supportive of this just due to the fact that China's been taking advantage of us for quite a long time, and a lot of people will back up a decision that we need to get something done with them. Obviously, we've struck new trade deals with Brazil and recently Japan. So we have a track record of making some better deals, and we backed out of the horrible Iran deal. Let's forget about that. Awful money right there. Paying too much money for all that. But anyways, we're gonna go ahead and end it here. I think I'm gonna make another video regarding how to trade during these market conditions. I think let's get out of this trade war. Please, let's make a deal with China. Make it decent. At this point, I mean, I just want it over with. So let's go ahead and try to strike a deal. But I'm afraid it's not going to happen for a while. And as Steve Harvey always said, let's make a deal. That's not Steve Harvey.